When I think back to 2023 and the biggest surprises in the market, I think about the resilient growth in the economy. A lot of the forecasts at the beginning of last year were for a recession. Obviously, that did not happen. Much stronger growth in the U.S., but also coupled with continuing higher than expected inflation, although it started to come down. I think for going into 2024, we'll probably see less growth, but inflation's coming down as well. So to me, you had that big spurt of growth. It's probably over. We're still looking at a slower growth environment with inflation coming down. I still think that's good for credit.
Yeah, I think you're spot on. I think we, like the rest of the market, was actually off on that view. And I really think that going into 2024, the real question is was that soft landing that we're expecting to see potentially, that's being priced in more and more every day? Is that something that we're actually going to achieve in 2024, or really is inflation going to be more stubborn than I think that folks are anticipating?
For 2024, as far as opportunities in investment grade credit, I do think it's a carryover from last year, which carry is going to be very important. Yield advantage in corporates. Sweet spot for us has always been triple Bs. I think that continues to be a place we want to pursue opportunities. But I also think that the duration of investment grade bonds could start to play a bigger role as far as total return is concerned over the course of the next year. So you have that yield advantage. You've got the duration potential if rates continue to fall in here. I would also say that the discount dollar prices in investment grade bonds, very positive convexity as well. So the total return potential for investment grade bonds is potentially an attractive way to play bonds in the next year.
Yeah, I'm hearing a lot of things that are very similar to high yield as well. Convexity, of course, is something we talk a lot about, and it looks really good right now. So that continues to be a nice tailwind for high yield, but really it's security selection that was the first thing that I think of, and that's always going to be the backbone of what we do, especially when I think of high yield bonds. So I think the other thing that's going to be really important for us is to continue to just pay close attention to inflation and understand how that's going to impact the margin profiles of our credits that we're following, and ensure that we're really doing our security selection to the fullest extent that we can. Our expectation for high yield issuers is that 2024 should be a higher net new issuance market compared to 2023. We saw a lot of reluctance from high yield issuers in 2023, not really wanting to come to the market to print coupons that were substantially higher, in some cases hundreds of basis points higher than where they previously issued. So our expectation is that the back half of 2024, we'll see an increased amount of issuance in the high yield market. Our default expectations for 2024 are more or less in line with what we saw in 2023. It looks like we're starting to see some inflection in terms of just positivity with our models with regards to losses. So it actually looks like it's encouraging news right now, and there's opportunity for actually losses to decrease in 2024 compared to 2023. With that being said, I think we're very much keeping a close eye on corporate profitability and making sure that we understand where those losses are going to come from, and understand those credits individually, what are going to drive losses going forward.
Yeah, the crossover space is an interesting area in our opinion very often. And that includes bonds that are crossing over from being rated high yield into investment grade, or even fallen angels that are moving from investment grade down into high yield. So in the past couple of years, what we've seen is a lot more rising stars, a lot more credits that have been rated high yield moving into the investment grade rating category. We think that this year you're likely to see more of a balance in that space, but both offer a great opportunity for investors if you look back historically, in my view. In our opinion, the risks to our base case is slower growth, recession, and also we think inflation remains unstable next year. The potential for inflation moving higher, surprisingly, we would think would be a negative for the market and likely leads to the Fed being on pause for a longer period of time. Slower growth and higher inflation is likely going to lead to wider credit spreads. So we do think that those are the primary risks at this point in time from the investment grade standpoint.
Yeah, for sure. And on the high yield side of the credit quality spectrum, I'd say you're 100% right. We're going to be very, very keyed in on losses and understanding the dynamics between corporate profitability and inflation, surprising to the upside. So we'll be keeping a close eye on that for sure.
Away from the credit markets, I think we think about geopolitics and we think about just the dynamics that are out there right now, both in Europe and in the Middle East. And then finally, I would say that the specter of commercial real estate continues to hang over the markets, especially with the regional banks, and that's something we're going to continue to watch closely as well.